Welcome to this video for directors that provides an overview of the FDIC and discusses our examination process.
In this video, we'll review the structure and the mission of the FDIC. We'll also cover our examination process. As part of this discussion, we'll cover risk management examinations, specialty examinations including Bank Secrecy Act, Information Technology, and Trust, and lastly, Consumer Compliance and Community Reinvestment Act, or CRA examinations.
First, let's talk about the FDIC structure. The FDIC is overseen by a 5-member board of directors, headed by the designated chair. Other members of the board include a vice chair and an internal director. All of these members are nominated by the president and confirmed by the Senate. By statute, either the chair, the vice chair, or the internal director must have state bank supervisory experience. The remaining board members include the comptroller of the currency and the director of the Consumer Financial Protection Bureau, who serve by virtue of their positions at their respective agencies.
The FDIC is headquartered in Washington, D.C. There are 6 regional offices throughout the country that are supported by smaller field offices.
All of the FDIC's employees work to promote and carry out the FDIC's mission, which is to maintain stability and the public's confidence in the financial system. So how is this accomplished?
Well, the FDIC does this by ensuring bank customer deposits, examining and supervising banks for safety and soundness and consumer protection, making large or complex financial institutions resolvable, and managing receiverships in the event an institution fails.
To carry out our mission, the FDIC has 3 programs: insurance, supervision, and receivership management. With respect to insurance, the goal is to make certain that insured deposits are protected from loss without the use of taxpayer funding. Under the insurance program, the FDIC provides depositors with timely access to insured funds and financial services when a bank fails. We also oversee the Deposit Insurance Fund, or DIF, which is funded through assessments on banks as well as investment income on the balance of the fund. The FDIC continually evaluates the adequacy of the DIF by identifying risks to the insurance fund. We do this by analyzing regional, national, and global developments. And when a bank does fail, we make sure that it is resolved in the least costly manner to the Deposit Insurance Fund.
Under the supervision program, the FDIC has multiple goals. One is to make certain that FDIC-insured banks are safe and sound. Another goal is to ensure that consumers' rights are protected and that banks invest in their communities. In order to carry out this part of our mission, the FDIC conducts different types of examinations of banks. We'll talk more about these examinations in a minute.
One related goal is to ensure that large or complex financial companies can be resolved in an orderly manner under bankruptcy. We accomplish this by working jointly with the Federal Reserve Board. Together, we review plans developed by certain large financial companies that show how the companies can be resolved in a rapid and orderly way under the U.S. Bankruptcy Code in the event of financial distress.
Finally, under the Receivership Management Program, the goal is to make sure that resolutions of failed banks are orderly and that receiverships are managed effectively. The FDIC does this by managing the assets of failed banks to preserve their value and returning these assets to the private sector as quickly as possible. Additionally, the FDIC works to ensure that if there is a large or complex bank failure, it is resolved appropriately with minimal disruption.
Now, let's focus on a key part of how we carry out the FDIC's mission, examining and supervising banks. Let's talk first about which banks the FDIC examines, and then we'll cover the types of examinations we perform. The FDIC serves as the primary federal regulator for state-chartered banks that are not members of the Federal Reserve System, in short, state non-member banks. This means that the FDIC is the federal regulator responsible for supervising those institutions. A key part of the supervision process is conducting examinations.
But remember that the FDIC insures banks with other charters. We insure national banks as well as state-chartered banks that are members of the Federal Reserve System, or state member banks. The FDIC is not the primary federal regulator of those banks. However, we monitor the potential risks of those banks by reviewing various information, including examination reports completed by other regulators. In addition, the FDIC has special examination authority, also known as backup authority, which allows us to examine those banks when necessary.
The FDIC conducts several types of examinations as part of our mission. The risk management examination is how we evaluate the safe and sound operation of a bank. It's at times referred to as the safety and soundness examination. As part of this examination, we conduct a number of specialty exams, including Bank Secrecy Act exams, information technology exams, and exams relating to a bank's fiduciary activities. We also conduct consumer compliance examinations and Community Reinvestment Act examinations. We're going to talk about these examinations so you're familiar with the specific purpose of each as well as the process the FDIC follows.
But before we begin discussing this, we want to touch on bank director involvement in examinations. We'd like to emphasize that the FDIC welcomes any opportunity to speak with directors. Although we maintain contact with bank management throughout the different exams, often we do not get to speak with directors, especially outside directors. As part of every examination, we welcome discussion with directors on virtually anything pertaining to the examination, industry, or regulatory environment.
Now, let's begin our discussion of FDIC examinations. Risk management examinations are conducted in order to ensure public confidence in the banking system and to protect the Deposit Insurance Fund. Risk management examinations help the FDIC ensure bank stability by identifying undue risks and weak risk management practices. In addition, a key part of every examination is evaluating a bank's compliance with laws and regulations. Bank examinations also help the FDIC identify, assess, and respond to emerging risks within the banking industry.
Ahead of a risk management examination, a member of field office management contacts bank management to discuss the upcoming examination and obtains some general information about the bank's operations in order to begin the risk focusing or scoping process for the upcoming examination.
The examination scope will depend in part on the bank's specific exposures and risks. For example, if a bank has new product lines or services, asset or funding concentrations, or if there are concerns noted in prior exam reports or audits, we'll look at those areas. The FDIC's goal is to conduct a thorough examination while remaining risk-focused.
The scope will be determined by the person assigned to lead the examination, known as the Examiner in Charge, or EIC. The EIC will develop a targeted list of requested items that the FDIC needs to examine the bank based on its unique business model, risk profile, and complexity. The examination team will also be determined based on this information as well as the bank's size.
Examination activities will take place on-site at the bank as well as at off-site locations such as the local field office. The FDIC wants to complete as much examination activity off-site as possible to reduce the burden of having a full exam team at the bank.
Examination activities are centered around key examination components: capital, asset quality, management, earnings, liquidity, and sensitivity to market risk. Collectively, these are known by the acronym CAMELS. CAMELS components are assessed and rated using the Uniform Financial Institutions Rating System, which is a standardized rating system for the CAMELS adopted jointly by the federal bank regulatory agencies. As part of the exam, a rating is assigned to each component. Examiners will communicate with one another about the findings from the component reviews, because findings involving one CAMELS component can impact the assessment of the other components.
After assigning ratings to these areas, a composite rating is determined. However, keep in mind that a composite rating is not an average of the CAMELS component ratings. Rather, it depends on the specific findings or concerns that may arise from the examination.
Ratings for all components and the composite are assigned based on the results of the examination. Generally speaking, A 1 rating is strong performance with no supervisory concern. A 2 rating is satisfactory with modest weaknesses correctable in the normal course of business. A 3 rating is less than satisfactory with some degree of supervisory concern. A 4 rating is deficient, meaning that operations may impair future viability of the bank and close supervisory attention is necessary. And a 5 rating is critically deficient operations in need of immediate remedial action and requires ongoing supervisory attention.
Now, let's discuss the risk management examination components in more detail, beginning with capital. First, we look at the level and quality of capital. Is it sufficient considering the risk in the bank's activities? Does it come from core, sustainable sources? We assess how responsive the board and management are to capital needs. For example, we consider whether dividends are reasonable given capital levels or whether appropriate capital planning processes are in place.
We also evaluate the level and trend of problem assets, as these could reduce earnings for capital augmentation or even deplete capital through charge-offs that flow through the allowance for losses. We analyze the composition of the balance sheet for risk. This includes reviewing product lines for risks such as interest rate or credit risk. We also look at any risk exposure that may be present off the balance sheet, such as through litigation. Finally, we assess current and projected growth, and we look at what other sources of capital are available.
The key point to remember when it comes to capital is that we assess the level of capital in relation to the nature of the risks of the institution being examined and the level of risk taken.
The asset quality component involves assessing both loans and securities. During this review, we evaluate loan and investment policies, administration and monitoring practices, as well as the overall quality of the assets themselves. As part of this, we review a sample of both loan and security files.
For this video, we're going to focus on the lending side since loans make up a larger portion of assets at the majority of banks. To begin, we look at the appropriateness of the policies and procedures. Are the board's expectations and standards formalized, and how are exceptions to the loan policy handled? Have acceptable standards for lending been established, such as debt-to-income or loan-to-value ratios? Are expectations conveyed and implemented bank-wide?
We also look at credit underwriting and administration practices. We consider the risk tolerance of the bank as set forth in policy. That is, what kind of loans does the board want management to make? From there, the expertise of the loan officers is considered. Do loan originators have the expertise to underwrite credits appropriately? We also evaluate whether loans are properly risk-rated. Overall, we assess whether the loan portfolio is monitored regularly.
Likewise, we analyze the level and trend of problem assets, including identification of problem assets. Is the level increasing, declining, or stable? And what is causing the trend? We evaluate the appropriateness of the allowance for losses and how much risk exposure is present on and off the balance sheet. We also analyze asset diversification, including the identification and monitoring of any concentrations. Finally, we consider board and management responsiveness to changes in the bank's asset quality.
The third CAMELS component is management. This component considers the oversight and support provided by both the board and senior management. The board and management have different responsibilities within the bank, but each play an important role.
Generally, board members don't need to be involved in the day-to-day operations of the bank. The board's role is to establish clear guidance regarding acceptable risk exposure levels and ensure that appropriate policies are developed. Senior management is responsible for developing and implementing policies and procedures that translate the board's goals, objectives, and risk limits into workable operating practices. Effective boards review policies regularly and update them as needed, such as when the board's risk tolerance or the bank's condition changes.
The management component rating essentially reflects the capability and performance of bank management and the board of directors. Examiners consider the oversight provided by the board and management. Oversight includes a number of elements: responses to changing conditions, policies and procedures, management information systems, audit and internal controls, compliance with laws and regulations, management depth and succession plans, responses to recommendations, and overall bank performance. Ultimately, this is about the ability of the board and management to identify, measure, monitor, and control risks to the bank.
Regarding earnings, first we look at the level and quality of earnings. Much like with capital, we ask, is it sufficient given the level of risk? And are earnings sustainable, or do they come from non-recurring sources? Likewise, can earnings provide for capital augmentation and provide to the allowance for losses? We also review the adequacy of budgeting systems. Finally, we consider risk exposure, such as interest rate or credit risk, and then determine the impact that could have on future earnings performance.
When reviewing liquidity, we review the sources and uses of funds, including the ability to convert assets to cash under various business and economic scenarios, while considering the cost to do so. We assess the diversification of funding sources, as well as the stability of those sources. Finally, we evaluate the adequacy of risk management practices, which include policies and procedures, monitoring reports, and contingency funding plans.
When we review our last CAMELS component, sensitivity to market risk, we look at exposure to market risk. For the majority of community banks, this will be risk associated with changing interest rates. We also look at risk management practices, including policies and procedures, measurement systems used to determine risk, and the independent review process of this area. Finally, we'll determine whether earnings and capital can support the level of market exposure.
Once the review of the various component areas is complete, we then begin finalizing the examination. We meet with bank management in order to talk about preliminary examination findings and recommendations. We also request management's responses to those findings and recommendations. From there, we finalize findings, assign examination ratings, and prepare the report of examination for presentation to the bank after regional office review and approval.
Within the report of examination findings are discussed, exam ratings are disclosed, and management responses are noted, including promised corrective actions for findings. All examination findings, including component and composite ratings, whether disclosed verbally or through a written report of examination, are confidential.
At the end of the examination, or after the report of examination is submitted for regional office review and approval, we typically meet with the board. However, this depends on examination findings, as well as how long it's been since FDIC staff and the board last met. The FDIC will meet with the board if the bank has a composite rating of 3, 4, or 5. The FDIC will also meet with the board of a well-rated bank if it's been 36 months since our last meeting, or if there are unsatisfactory component ratings.
So now that we've talked about the risk management examination process, let's talk about how often we conduct these examinations.
We conduct exams every 12 months, with some exceptions. If your bank has total assets of $3 billion or less and meets other criteria, then a longer examination cycle may apply. These other criteria include the bank being well capitalized, well rated, with no change in control since the last examination, and no formal enforcement action. For those banks, the examination cycle is extended to every 18 months. With that said, reviews may occur more frequently if there are regulatory concerns.
Let's move on to specialty examinations. Specialty examinations are typically conducted during the risk management examination when applicable. This means they will occur with the same frequency as risk management examinations, and any findings and recommendations will usually be embedded in the risk management report of examination. Also, it's important to note that findings from specialty examinations could impact risk management ratings.
Over the next few minutes, we'll discuss each of the different types of specialty examinations, starting with Bank Secrecy Act examinations.
The purpose of a Bank Secrecy Act, or BSA exam, is to evaluate the bank's compliance with the Bank Secrecy Act, which requires banks to maintain customer records and file reports for certain transactions. It also involves reviewing compliance with applicable sections of other related laws, including the USA Patriot Act and several anti-money laundering laws.
During the BSA exam, we look at the system of internal controls to ensure ongoing compliance with the BSA program established by the bank, independent testing of the bank's BSA program, management of the program, including having a designated BSA officer, and training that is conducted for the bank's staff. Additionally, we evaluate whether an appropriate customer identification program and customer due diligence process is in place. These areas relate to knowing your customers.
Ratings are not assigned to a BSA exam. Rather, the findings are considered when assigning the management component and the composite ratings for the risk management examination.
We conduct information technology or IT examinations to determine the confidentiality, integrity, and availability of records produced by automated systems. We do this through an evaluation of management's ability to identify risks and maintain appropriate compensating controls.
4 components are reviewed during an IT examination: audit, management, which includes board oversight of this area, development and acquisition, which refers to a bank's ability to identify, acquire, install, and maintain necessary IT system solutions, and support and delivery, which is an organization's ability to provide technology services in a secure environment. The IT components are rated using the Uniform Rating System for Information Technology. A composite rating is assigned based on the reviews of the 4 components. Similar to the ratings for risk management exams, a scale of 1 through 5 is used for IT, with 1 indicating strong performance and 5 indicating critically deficient performance.
We conduct trust examinations at banks that provide fiduciary services, such as account administration, investment management, or asset custody. The purpose of a trust department examination is to determine whether trust operations or account administration issues could result in an impact to earnings, or contingent or direct liabilities that could reduce the bank's capital accounts.
5 areas are reviewed during the trust examination: management, operations, internal controls, and audit. Earnings performance of the trust department, compliance, which relates to compliance with laws, regulations, accepted standards of fiduciary conduct, customers governing account instruments, account administration, and internal policies and procedures, and management of the assets handled by the department. These 5 components are rated using the Uniform Interagency Trust Rating System. A composite rating is assigned based on the reviews of the 5 components. Similar to the ratings for risk management examinations, a scale of 1 through 5 is used for trust, with 1 indicating strong performance and 5 indicating critically deficient performance.
We also conduct examinations of the small number of banks that serve as a government securities dealer, a municipal securities dealer, or a registered transfer agent. The purpose of these examinations is to ensure processes are established to maintain compliance with applicable laws and regulations governing these areas. Separate ratings, also on a scale of 1 to 5, are assigned for each of these examinations.
Now that we've covered specialty examinations, let's talk about Consumer Compliance and Community Reinvestment Act, or CRA, examinations. The FDIC's Consumer Compliance Exam program focuses on assessing a bank's compliance with federal consumer protection and fair lending laws and regulations. We evaluate whether banks have a sufficient compliance management system, or CMS, to effectively identify, address, and mitigate the risk of consumer harm. CRA examinations assess a bank's efforts to meet the credit needs of its designated community.
Similar to the process for risk management exams, ahead of the consumer compliance and CRA exams, the local field office contacts the bank and obtains information for the upcoming examination activity. This could be a consumer compliance exam, a CRA exam, or both. Then, the EIC will review available information to determine the exam scope and which activities will be completed on-site and off-site.
During the consumer compliance exam, examiners will assess the adequacy of a bank's CMS. We evaluate two primary areas: board and management oversight and the compliance program. The compliance program includes policies and procedures, training, monitoring and/or audit, and the consumer complaint resolution process. The size of the bank as well as the complexity of its operations are taken into account when assessing the effectiveness of its CMS. We evaluate whether the existing CMS effectively manages the risk of consumer harm and ensures compliance with applicable federal laws and regulations based on the bank's specific operations and risk profile.
For the Community Reinvestment Act, or CRA examination, the purpose is to evaluate whether a bank meets the credit needs of its designated community, including low and moderate income areas, consistent with safe and sound banking operations.
At the end of the consumer compliance examination, an exit meeting is held with management. In this meeting, we discuss the findings and conclusions of the exam. This includes noted strengths of the CMS as well as any recommendations for further enhancement. Any violations of law or regulation and/or consumer harm are also addressed, along with any recommended corrective actions.
The bank's CRA performance is discussed as well, if we also conducted a CRA examination. We will also request management feedback on these findings, conclusions, and recommendations. Finally, tentative ratings are assigned and disclosed. We then prepare the report of examination and CRA performance evaluation for submission to the bank after FDIC management approval.
Compliance reports of examination discuss exam findings, detail the exam rating, and incorporate management's responses. All examination findings, whether disclosed verbally or through a written compliance report of examination, are confidential. CRA performance evaluations disclose the exam ratings and sub-ratings and are required to be made available to the public by banks. They are also published on the FDIC's website. The Office of the Comptroller of the Currency and Federal Reserve Board publish CRA performance evaluations for banks they supervise on their websites.
Ratings for consumer compliance are defined by the Uniform Interagency Consumer Compliance Rating System. The rating system assigns a numerical value from 1 to 5, with 1 being the highest and 5 being the lowest. This rating is partially based on findings and conclusions regarding the two components of the CMS. These two components are each assessed by examiners as strong, adequate, or weak. Any violations of law and/or consumer harm identified during the exam are also factored into a bank's compliance rating.
CRA examinations assign ratings using the terms outstanding, satisfactory, needs to improve, or substantial noncompliance. An important point to note: by law, a bank CRA rating is considered when the FDIC evaluates applications for branches, mergers, and acquisitions.
The FDIC conducts consumer compliance and CRA examinations simultaneously whenever possible. For consumer compliance, the examination cycle is every 12 to 36 months, depending on the bank's consumer compliance rating and asset size. CRA examinations are completed every 12 to 72 months, also depending on the bank's CRA rating and asset size.
In summary, the FDIC's mission is to maintain stability and the public's confidence in the financial system. We carry out our mission by ensuring customer deposits, examining and supervising banks for safety and soundness and consumer protection, making large or complex financial institutions resolvable, and managing receiverships in the event an institution fails. As part of the FDIC's supervisory responsibility, we conduct several types of examinations, which we have discussed during this video. And as we mentioned earlier, we welcome the opportunity to speak with bank directors during any of these examinations.
As we conclude, we'd like to remind you that the FDIC has technical assistance videos on a number of other topics that can be found on the Banker Resource Center at www.fdic.gov. There are many resources available on the FDIC website, including the Risk Management Manual of Examination Policies and the Consumer Compliance Examination Manual. If you need additional information or have questions or comments, please contact your bank's Risk Management Case Manager or Compliance Review Examiner, or email the FDIC at supervision@fdic.gov. Thank you for viewing this video. We hope you found it both useful and informative.